In this video, we explain profit and loss situations for a perfectly competitive firm, with a clear focus on the shutdown condition.
A firm is faced with horizontal consumer demand curve, perfectly elastic demand. This is because each firm is a price taker. It can sell any quantity it wants at the market price but cannot influence the price. Total cost is sum of fixed and variable cost, given by this total cost function. Marginal cost is derivative of total cost, with respect to quantity. Equate the two and solve for equilibrium quantity level, which is 28.93 units. Check that marginal cost at this equilibrium quantity is 80, equal to price or marginal revenue. The equality of marginal revenue and marginal cost means that the addition to total cost for the production of an additional unit is exactly equal to the addition to total revenue earned from selling the unit.
To these two curves of marginal revenue and marginal cost, next we add two more cost curves. Short-run average total cost, or average total cost, is given by this quadratic function. Short-run average variable cost is given by another quadratic function. Note that marginal cost curve intersects two other cost curves at their minimum. In fact, these minima are very important from profit and loss in the short and long run. When price level is below minimum average total cost, firm incurs loss. Let's find these minima points.
Take derivative of these two cost functions and set them equal to 0, then solve for quantities. Average total cost is minimum at 25 quantity level, and average variable cost is minimum at 15 quantity level. Solving. These functions at their respective quantities give their cost levels 60 and 30, respectively. We can show these points on the diagram. Take note of the fact that a price line given by the competitive market can fall anywhere above, below, or between these cost curves. When price line is above minimum of average total cost, firm enjoys economic profits, also called supernormal or positive profits. When price line is tangent to the minimum of average total cost, firm gets zero profit, also called normal profit.
When price line falls in between two minima, firm incurs loss, but still operates for what is called as loss minimization. How long it can sustain losses. To produce, it has to think in terms of fixed cost and average variable cost. Fixed cost is also known as sunk cost, so it is variable cost which may be saved by stopping production, not fixed cost which is already incurred at the start of the production process. If price and revenues are at the level that the variable cost can be covered, firm continues to produce and sell to minimize losses. If price line falls below the minimum of average variable cost, it is better for a firm to shut down and stop production. This is to minimize loss. In the case of loss, when price is above minimum of average variable cost, but lower than average total cost, the difference of price and average variable cost contributes in lowering the fixed cost loss. When price is lower than the minimum average variable cost, there is no such contribution to reduce fixed cost loss, so it is better to stop production.
As an example, in this diagram, with given price of 50, per unit analysis shows that even though 60.47 minus 50 equal to 10.47 is loss, 50 minus 32.88 equal to 18. 0.88 is the contribution towards reduction of the fixed cost. For the price below the minimum of average variable cost, shutdown is usually temporary in the short run. If firm waits and sticks to the industry and prices rise, in the long run, the equilibrium price would be equal to the minimum of short-run average total cost, which is also the minimum of long-run average total cost. These two cost curves are tangent at this point, and price line is tangent too. Normal or zero profits are made in the long run.